Great! You've reached the first flag. Move on to the next to come closer to your goal. You are at your very first yellow flag called the entire contract clause. This clause states that first, the policy owner is assured that every word of the contract is contained in the contract. The contract is made up of the policy and the attached application, including a report of physical condition. The contract cannot be affected by later changes, since all the company's obligations and the policy owner's rights have already been written. Second, the company accepts the applicant's statements as representations. This means that, to the best of the applicant's knowledge, the statements are true. Even if the statements are found to be untrue, the contract may still hold. The company would have to prove that it relied so heavily on an untrue statement that it otherwise would not have issued the policy or would have issued it with modifications. Click on Back to Provision Mountain to see your progress. You are at the second flag, called Ownership Provision. This provision states that policy owners have valuable rights under their insurance contracts. In this provision, policy owners have the right to assign, transfer, or have their policies amended. They can also change their beneficiaries and exercise every option and privilege provided in their contracts or allowed by company practice. They also have full rights to cash values and dividends, if any, under their policies. They may also transfer these rights to others if they so desire. Good job! You've reached the second yellow flag. Move on. You are at the third yellow flag called Premium Payment. The premium payment clause tells us that premiums may be paid either annually, semi-annually, and quarterly. After the contract becomes binding with the payment of the first premium, the payment of the subsequent premiums is entirely dependent on the will of the insured. Therefore, as long as the policy owner keeps on paying the premiums, the company is bound to carry out its part of the contract, whatever the future may be. Great work! You've reached the third yellow flag. Move on to the next to come closer to your goal. You are at the third yellow flag called Premium Payment. The premium payment clause tells us that premiums may be paid either annually, semi-annually, and quarterly. After the contract becomes binding with the payment of the first premium, the payment of the subsequent premiums is entirely dependent on the will of the insured. Therefore, as long as the policy owner keeps on paying the premiums, the company is bound to carry out its part of the contract, whatever the future may be. You are at the fourth yellow flag called Grace Period. The grace period provision occurs when the policy owner neglects to pay premiums on the due date of the policy. This provision protects the policy from lapsing. The insured is given a period, normally 30 days, to pay for his premium after the due date. In this scenario, the policy is still in force and has not lapsed yet. If the insured passes away within this period, the proceeds of the policy will be deducted by the unpaid premium due. Wow! You've reached the fourth yellow flag. Move on. You are at the fifth yellow flag called Policy Loan. One of the privileges the insured can take advantage of during the lifetime of the policy is the right to loan against its cash value. Within prescribed limits, policy owners may borrow money against their policies if they wish. However, the amount should not exceed the cash value of the policy. These loans may not be called by the company, and the policy owners may repay the loans at any time. But be careful, for interest on these loans will be charged to the policy owner. If the loan is unpaid at the time of death of the insured, loan balances and any interest dues are deducted from the proceeds of the policy at the time of claim settlement. Amazing! You've reached the 5th yellow flag. You are at the 6th yellow flag called assignment. A life insurance policy is an asset. Since it is their property, policy owners have the right to transfer or assign them. If they wish to secure loans, they, as assignors, can assign their policies temporarily to the lenders as security for the loan. The policy is said to be assigned. The assignment clause sets forth the procedure of assigning one's policy. Because a life insurance company is involved, the policy owner must notify the company in writing of any assignment, and the company will accept the validity of the assignment without question. The recipient of a policy is called the assignee. Awesome! You've reached the... You are at the 7th yellow flag called dividend options. Dividends are paid on participating policies. At the end of the year, the company issuing participating policies looks over the year's operations. If there were fewer claims than anticipated, investment earnings were better than expected, and expenses were less than estimated, then a surplus results. The company can return a part of the policy owner's premium in the form of dividends. However, they are not guaranteed. Dividends vary from year to year and generally start to build up after the 2nd year. To get your dividends, there are 5 options to choose from. Policy owners may choose to have their dividends paid in cash, use them to help reduce premium payments, leave them with the company to accumulate and earn interest, use them to purchase paid-up insurance or paid-up additions, use them to buy yearly renewable term insurance with any extra cash remaining on deposit with the company and earning interest at a rate to be declared by the company from time to time. Don't forget the order of these dividend options. To make it easier to remember, use the acronym CRIPI. C stands for cash. R stands for reduce premium payments. I stands for interest. P is for paid-up additions. And Y is for yearly renewable term insurance. Fantastic! You've reached the 7th yellow flag. You have now established your base camp. You and your companions are now a step closer to the summit. Base camp has now been established. Don't lose focus on your goal, which is to reach the summit of Provision Mountain. The road to the top has now been difficult. Obstacles have now gotten into the picture. Unfortunately, one of your companions came across a treacherous accident and fell into a cliff. Just like your life insurance policy, the insured has different provisions when the insured passes away. Click on each blue provision flag to continue. You are at the first blue flag called misstatement of age. The age of the insured is very important to determine the correct premium rate for life insurance.